Okay, good morning. Okay, so today we're going to finish up Chapter 7. I always think this. We're probably going to get out a little bit early in here, the 7:45 class, because I believe there is a statewide tornado drill this morning at 9:50, which will impact my second class. So I don't want to get us way ahead, and so I want to be at the same level. So we might get out a few minutes early in here. And know that if you're in other classes, it is, I believe there is a statewide tornado drill, unless I completely read the date wrong. Okay, learning catalytics again, accuracy grading, just like we have in the past days. What's due this week? Chapter 7 homework. You need to allow adequate time to do the homework because it will be a little involved. I am emailing out today at least links to at least 2 homework problems that are step-by-step again. So if you need help beyond what we do in class, I do have those again for. So whatever homework problems you have, I think you'll either have gone over them in class or you'll have links for them. And that should come out later this afternoon. Okay, exam 2 is March 16th through 18th. That is not next week. That is the week after. I will be talking about the exam next week. If you want to get a jump start on it, you're welcome to go into study plan, the contents there. The practice exam will be available starting this Sunday, the 8th. If you're in sections 5 or 6, you want to register or schedule your exam on ProctorU as soon as possible because you're going to get the best selection of dates. Remember, this is the week for us before spring break. It's also the week before spring break for a lot of schools across the country. So ProctorU selection of times and dates might be limited the longer you wait. So as of this morning, I think we have 200 students that are taking it on ProctorU. They're about 200 to 250, somewhere in that range, and only 48 people have scheduled their exam. And it's okay with me if you wait to schedule. I'm just trying to tell you that it might be better to schedule earlier as opposed to later. And of course, if you're in the lab, I would not wait till Wednesday afternoon because this is historically the week before spring break. There's, I think, 8 exams going on in the lab. Probably, chances are Monday and Tuesday will be fine. It's going to be Wednesday. It's going to start the long lines. And our exam ends Wednesday, fortunately, but I would expect long lines on Thursday because, again, the last day to drop the class is the Sunday after that week. So everyone wants to get that exam in, and that's why it's just a perfect storm in terms of number of exams. Okay. So, Chapter 7. There is a question in learning catalytics. It will stay open for a few minutes. So, it's there now. Which of the following is not one of the 3 main depreciation methods? So, we have the 3 there. I'm going to show the answer now, but the question will stay open for a couple of minutes in case you haven't quite logged on yet. So with this question, so it's not going to close on your device yet, but the 3 depreciation methods are straight line, units of production, and double declining balance. Residual value is what we think the cash value of something will be at the end of its estimated useful life to us. So the answer is residual value. Okay, so getting into this, we're going to kind of overlap with where we left off on Monday. We said the original cost, so this is overlap territory. Original cost of the plant asset less accumulated depreciation gives us the book value of the plant asset. So book value, original cost less accumulated depreciation. Accumulated depreciation is a contra asset. A contra asset goes on the balance sheet. It is always shown with the plant asset it's related to. So contra asset is a balance sheet account. It has a normal credit balance. It offsets assets. Oh, okay. The Morning Journal, the fire drill postponed until March 6th. Well, great. Thank you. I had not read yet today. Okay. Running total of all depreciation expense for asset is accumulated depreciation. So you need to know what accumulated depreciation is. It's this account that holds all the running total of depreciation. Depreciation is the way we get the cost of the plant asset into the income statement over the life of the asset. So every period we take a certain amount and put it in depreciation expense, and it gets added into accumulated depreciation. So accumulated depreciation grows over time. Okay? At the end of the useful life, the book value of an asset will be equal to its residual value. It is very possible to have a residual value of 0. Okay, but if you have a residual value, this is what the company estimates it'll be worth at the end of its life. That's what the book value will be at the end. Okay, so I'd say this slide is pretty important stuff. Okay, these are a lot of important concepts there, and again, this is overlap from Monday. So if it sounds familiar, it should. And as we use an asset, as we progress into the life of an asset, accumulated depreciation will increase, the book value will decrease. They're opposite sides. And the final book value is its residual value. Okay, I want to make an announcement for accounting majors. I do not have a slide of this. So if you are an accounting major, there is a wonderful opportunity. If you're an accounting major, one career choice you have, and a very common career choice, is to go to work for a public accounting firm. And public accounting firms, one thing they do is they go in and audit financial statements to verify that the financial statements are representing real things, for example. You can also go into tax with an accounting firm. But there's four international Big Four accounting firms, the 4 largest, and then there's a couple that are really close in size. And these firms actively recruit, and they start recruiting at this point where you are now. If you're an accounting major, you should probably be a sophomore thereabouts. The accounting firms start recruiting at this level. So they don't wait till you're a senior to recruit you. They start now. So a couple years ago, Haley attended something called the Summer Leadership Institute for Grant Thornton, which is the accounting firm she's going to work for. And this Summer Leadership Institute was a few days. Grant Thornton took students from all over the country, flew them to one location. Where'd you go? Chicago. And they spent a few days with activities with the students, showing them what they do. There were a lot of fun activities planned. And Haley is actually going to work for Grant Thornton now. That was her first connection with Grant Thornton, and it turned into be a full-time job. So the reason I'm telling you this is Deloitte, which is one of the Big Four firms, has a summer leadership conference. And it's an all-expenses-paid trip, and this one is to Texas. It's actually to Deloitte University. Deloitte has their own university. These accounting firms are mammoth. They're huge. When I took students to Paris and London, we visited Deloitte in Paris. They've got worldwide operations. But anyways, they have a summer leadership conference and here's the requirements. You have to be currently a sophomore and or someone who's 2 years away from final graduation. So if you're sitting in this class, you're probably 2 years away from graduating as an accounting major. Generally 3.2 minimum GPA, strong communication skills, interest in audit, tax, or advisory services, okay, and then desire to live in the Cleveland area when you graduate. So they're looking to recruit students to go to this Deloitte Summer Leadership Program. The leadership program itself is Tuesday, July 7th through Friday, July 10th. And it is all expenses paid, and you go to Texas and you're with a bunch of accounting majors from across the country. This is very prestigious to get one of these, but it's also very doable. If you are interested, I don't have an email address. If you're interested, just send me an email and I will connect you with who you need to contact. But it is a great opportunity, and if you're interested, you're going to have to contact me in the next day or two. Don't wait. So let me know if you're interested. And if you're interested in general, just let me know and I'll keep you on a list and I'll let you know when other ones of these pop up, because generally most of the firms are doing these kind of things, and they do start recruiting. It's really cool as an accounting major to go into your junior year, end of your junior year, and know that you have a job waiting for you 2 years later. A lot of accounting majors, get their bachelor's degree after their senior year, fourth year, and then do a fifth year to get their master's, because to sit for the CPA exam, you have to have 150 hours. And generally, we recommend, unless you have a lot of post-secondary credit or something like that, generally a master's degree is going to serve you well, a master's in accounting. Okay, so there's my public service announcement. So accounting major interested in a summer leadership conference with Deloitte, send me an email. Okay, so now, this is not in the PowerPoint slides that I put online. I added this yesterday as I was thinking about it. We have 3 depreciation methods. I'm going to go through the depreciation methods today. The first one is straight line depreciation, the formula. I wanted to put all the formulas in one spot. We are going to go through each of these. We're going to do the calculations, but as I thought about it yesterday, I thought I want to get these formulas in one spot. So we'll be using these coming up here soon. So straight line depreciation is our original cost minus residual value. So that's called depreciable cost in total. So we have our original cost less the residual value. That's what we can depreciate. So we call that depreciable cost, and divide by the estimated useful life. Straight line, easiest method, because we're taking what we can depreciate over the estimated life. That's it. It's going to be the same amount every year. Then we have units of production. Now, units of production is getting a depreciation figure per hour, per mile, however we say our asset is going to be measured. If it were a vehicle, we might say our vehicle has a life of 100,000 miles, for example, and then we'll figure out depreciation based per mile. If we're dealing with copy machine, it could be per copy because they're rated for how many copies go across the drum. And so units of production could be hours. It could be, machines are often rated by how many operating hours they have. So units of production is getting depreciation per whatever that measure is. So to do that, we take, again, the depreciable cost, the original cost less the residual value, and divide that by our estimated unit. Okay, and those estimated units, those are things like how many miles are in the life of our car, how many hours is this equipment rated for its estimated useful life. So units of production, you get the depreciation rate per mile, per hour, per copy, whatever you're measuring it of. And once you have that, you take that per unit depreciation times the actual units. So you're getting a depreciation per unit figure, and then you're multiplying it by how many units. So it's a two-step process for units of production. Okay, I'm going to address a couple of those questions right now. This formula slide is not in the PowerPoints that are on Blackboard. I thought of it yesterday, so it is here. But all these formulas are in the slides that we're covering. I just wanted to put them in one spot here. And the question about do you multiply or divide, you do both. For units of production, you're taking the depreciable cost, dividing by the estimated units, and then to get your depreciation, you take the per unit depreciation times the number of units. And again, these are kind of conceptual until we actually use them. We're going to use them in an example coming up here. Double declining balance method. This one, the formula is basically taking the 2, it's always 2. 2 divided by the estimated life in years times the equipment or item's book value. And again, we're going to go through an example of this. I just wanted to get these formulas in one spot. We will see these formulas over and over and over, but here they are all in one spot. So what we're going to do now is we're doing an example. It is in the PowerPoint slides, and we're going to do straight line, and then we're going to take the same set of data and do units of production, and then we're going to use that same example and do double declining balance method. So we're going to walk through how you do each of these methods. And these examples, again, other than this slide, pretty much everything else, the examples are in the PowerPoint slides on Blackboard. Okay, and we will see these formulas as we go forward. So here's our example, and we're going to use this probably for the next half hour. Ralph's Pizza bought a used Toyota delivery van on January 2nd for $13,000. Okay, so when we do depreciation, we're dealing with whole years and whole months. January 2nd is the same as buying it at the beginning of the year. We're not ever going to have a situation in here where we bought it January 20th or something. It'll be whole month. For right now, we're doing with whole years. A little bit later today, we'll talk about what happens if you purchase it in May, for example. But for right now, whole years. Okay, so they bought a delivery van for $13,000. The useful life of the van is 5 years. So this company says, wow, we're buying this van, we plan to use it for 5 years. That doesn't mean the van will disappear off the earth in 5 years. It just means that this company has said, this is our estimated life. At the end of its useful life, the company estimates that the van's residual will be $1,000. So there's two numbers there that we are given that are estimates by the company. First of all, the estimated useful life. You will always be given that. Also, the estimated residual value. You will always be given that. Companies have to do a certain amount of estimating here. There is guidance for life, and a little bit later I'm going to show you what Walt Disney Company uses as life for some of its assets. So we have the purchase price, the residual value, the estimated life. Those are the three items we need to calculate depreciation. Now it tells us to prepare a schedule of depreciation expense per year. So a schedule of depreciation expense is going to list each year and then calculate the depreciation for each year. And we're using straight line method. Okay, so I have to leave the facts here, but the three facts you need out of a whole big paragraph: it costs $13,000, the life is 5 years, and the residual value is $1,000. Okay, that's what we need. So the original cost, $13,000. Okay. So the original cost less the salvage value, remember salvage value is another name for residual value, is depreciable cost. So I'm going to calculate that. So this A, B, C, D, these are just things that I'm coming up with as I go. So first, I know I'm going to use this formula, original cost minus salvage value, or residual value, same thing, gives us depreciable cost. So I take $13,000 minus the $1,000 residual value, salvage value, and I get $12,000. That $12,000 is how much I'm going to depreciate over time. Okay, I can't ever depreciate the residual value, so that never gets depreciated. So I have $12,000. Now, our depreciation expense is the depreciable cost divided by the estimated life. Now, the depreciable cost is the original cost minus the residual value. So again, $12,000. We're going to take $12,000, divide by 5 years, $2,400 a year. This one's really easy. Straight line is not bad. The big thing to remember is to subtract that residual value. You cannot depreciate a residual value. So we have $2,400 a year. We're almost done now. Now we just need to make a schedule, and the schedule's just going to say, here's how much depreciation each year. So when we're dealing with straight line, it's pretty straightforward. That's why it's such a popular method to use. Straight line, you just take depreciable cost, divide by number of years, and you're pretty much home free. So here is what we would call a depreciation schedule. I eliminated one column, that blank area, because we didn't really need it. So accumulated depreciation is a running total of all depreciation to date. And the book value is the original cost minus accumulated depreciation. Okay, let me go back. Okay, so what we're doing here is in this schedule, all of a sudden there's a lot of numbers that pop up and they're not bad. So in the first year, in 2014, our depreciable cost is $12,000. Our depreciable cost doesn't change in any year. The depreciable cost remains exactly the same, so it's always going to be $12,000. The next column over, annual expense, that's super easy because under straight line depreciation, it'll always be $2,400. Accumulated depreciation is a running total of all depreciation expense to date. So this accumulated depreciation here that we have in the first year, that is simply this depreciation expense from 2014 because that's all the depreciation expense we have. For the second year, it's going to be the first year's accumulated depreciation plus this year's. So the $4,800 is last year's balance of $2,400 plus this year's $2,400. The accumulated depreciation for year 3 is going to start with the $4,800 from last year and add the $2,400 from this year. So with accumulated depreciation, it's just a running total of all the depreciation to date. And then the book value column, that is going to be always going to be the original cost minus the accumulated depreciation. So this is going to be, for example, for the first year, it's going to be $13,000 minus $2,400. Don't fall into the trap of saying $12,000 minus $2,400 because we're talking about the original cost. The book value is always the original cost less the accumulated depreciation. So this original cost less the accumulated depreciation, erase this. We're going to talk about that coming up. Just put it off for right now. Okay. Not to totally. It's just I got it. We'll talk about that situation. Okay. So the book value column is always going to be the $12,000, the first number, minus the accumulated depreciation. Okay, and that's how you're getting to that. So every row is going to be that original cost less the accumulated depreciation. So straight line, pretty straightforward, going to be the same amount every year. Remember what depreciation is not. Depreciation is not a value. It is not a valuation method. It doesn't have anything to do with market value. It's a way for us to match the cost, the expense of that asset with the revenue that that asset is helping to generate. So we're spreading the cost of the asset over the life of the asset. So straight line, as long as we have, if we buy it at the beginning of the year, we have in this case, 5 years. Every year the depreciation is going to be the same. Accumulated depreciation grows over time. Book value decreases over time. At the end of this, at the end of the life, at the end of 5 years, notice that the ending book value at the end of the asset's life is equal to its residual value or its salvage value. So straight line, easy, easy, easy. And a lot of companies use it. No, book value, I'm answering that one. I'm answering, isn't the book value the depreciable cost minus accumulated depreciation, not original cost minus accumulated depreciation? No, book value is the original cost less accumulated depreciation. Okay, so don't make the mistake of grabbing the depreciable cost. Depreciable cost is only used for calculating the depreciation, but book value is the original cost minus the accumulated depreciation, and at the end of our asset life, that book value has to equal the residual cost. Okay, so now leaving straight line behind. Now we're going to go on to units of production. So we have the same set of facts. We have to be given a little more information. So before we were told that the van had an estimated life of 5 years. Now we're being told a little additional information, and now we're told that the van has a life of 100,000 miles. Okay, and then further, it's telling us that the van traveled 15,000 miles the first year, 30,000 the second, 20,000 the third, 25,000 the fourth, and 10,000 the fifth. Okay, that's information we have to be given. The company's going to have to look in its crystal ball and make a reasonable estimate of what's going to happen. But this is for our purposes of our exercise. What the company does is it comes up with the estimated life in terms of miles, and then each year it uses the actual miles that it drove. In our example here, it's projecting because we're doing it ahead of time. But you would normally do this after each year. Okay, so we're going to leave this information here, and we're going to calculate the depreciation. So we start with the same schedule. We're going to have a column for miles driven, rate per mile, annual expense, accumulated depreciation, book value. So the first thing we have to do is at the bottom of the screen, we need to get our depreciation per unit of output. Our unit of output this time is miles, because we're told that this delivery van has a life of 100,000 miles. So we're going to take the original cost, 13,000, subtract the residual value of 1,000 to get our depreciable cost again. So there's that 12,000, and divide by 100,000 miles. So what we get is 12 cents a mile depreciation. So units of production, we're getting a depreciation per whatever our units are. In this case, our units are miles. So now, first year. Here. Batteries? I don't know. Huh. That is weird. Well, let's go to the next slide and see. Weird. Okay, so let's see if we can get this guy to work here. There we go. Okay, it's working now for whatever reason. Okay, so year one, year 2014, the first year, we drove 15,000 miles. They told us we drove 15,000 miles. So we take it times the 12 cents per mile that we just calculated, and we get annual expense of $1,800 for the first year. Okay? So then what we're going to do for the accumulated depreciation, is our prior accumulated depreciation plus this period's depreciation expense. So, yeah, there's the 12 cents times the 15,000. So our accumulated depreciation is $1,800 because we don't have any prior. And then our book value is the original cost of $13,000 minus the $1,800 to give us $11,200. Units of production is not bad. It's actually kind of easy because then each year you just take how many miles they drove times that 12-cent rate, and that's all you're doing each year. So when we go to year 2, 2015, I wonder what, it doesn't like to move. Oh, whoop, look at that. Okay. Huh, that's kind of weird. Okay, so year 2, the mysterious slides today. Year 2, we drove 30,000 miles, so we would take, crazy. This is the animation gone bad. That's all I can figure is I've got everything out of order. Okay, So I apologize for that. 30,000 times 12 cents is going to give us 3,600 for the annual expense for 2015. Our accumulated depreciation is going to be the 1,800 from last period plus the 3,600 from this period gives us 5,400. And then our book value is going to be the 11,200 book value from last time less our annual expense 3,600 this time. Alternatively, we could take our original cost of 13,000 minus the accumulated depreciation of 5,400, and that will give us our book value, 7,600. Oops. Yeah. Okay, so for the rest of our schedule here, okay, so for year 2016, 20,000 miles driven, 20,000 times 12 cents gives us 2,400. Our accumulated depreciation is going to be last time's 5,400 plus this time's 2,400 to give us 7,800. And then book value will be the original cost of 13,000 minus 7,800 to give us 5,200. Then for 2017, we're going to do the 12 cents times 25,000 miles gives us 3,000. The 3,000 is added to the 7,800 to get 10,800 for accumulated depreciation. And then our book value at the end of 2017 is going to be our original cost of 13,000 less 10,800. And there are a couple ways you can get to those numbers. And then finally 2018, 10,000 miles times 12 cents gives us 1,200 annual expense in year 2018. Our accumulated depreciation is 10,800 from last time plus the 1,200 this time gives us 12,000. And then our book value at the very end should be equal to the residual value. The residual value is 1,000, so our book value is going to be the original cost of 13,000 minus 12,000 gets us to that magic 1,000 number. Okay, so the only thing with that is it's rather tedious to do all the math. In real life, we have computer programs to do it. The ones you have to do in here I don't think they'll be more than 5 years at the most. So that's units of production. Units of production can only be used when you have a production method, a production or something associated with the unit. So this will work well for cars with miles, airlines with their hours, how long their engines are rated for, etc. But if you have a building, what could you do units of production for a building? Buildings are generally time. So there's a lot of assets that don't have an underlying production going on, and you can't use units of production with a lot of assets like buildings. Buildings, it's a function of time. So then we come to the next one. And to be honest, the next one is the one I always found the most challenging. These two, straight line, pretty easy. You divide the depreciable cost by the years and you're pretty much done. Units of production, you get a depreciation amount per unit. But then double declining balance, it's kind of odd because double declining balance takes a lot of depreciation up in the beginning and less later on. So we're going to do this, the exact same information given to us as for straight line. Okay? Double declining balance roughly is double straight line. That's why it's called, but it's a double declining balance. It's referring to the book value. So we're going to do double declining balance now. Okay, so same information. The first thing we need to do is get the declining balance rate. The declining balance rate will always, always, always be 2 divided by the number of years. The number one question I get is where do we get the 2? The 2 is built into the formula because this is twice the straight line rate. Okay, that's where the 2 comes from. The 2 is not something you will ever have to change. The 2 is just built in. So it's always 2 what are the actual units? The units will be given to you. It'll be like the delivery van was miles. It can be anything. It could be miles, it could be hours, it could be number of copies, but that's what's given to you. So there's not a generic definition. So we just use units. Okay, so back to declining balance rate. So declining balance, you have to get this factor. So it's always 2 divided by the number of years in the life. So 2 divided by, this has a life of 5, so we get a declining balance factor of 0.4 or 40%. I think we have another, let's go with this. There. Yeah. Okay, so let's start off. This one's different than the other 2 methods in that you don't use depreciable costs. It's the only method that residual value does not come into play until towards the end. So, first thing, our beginning book value. Our beginning book value when we buy a piece of equipment is its cost. So our beginning book value is $13,000. Okay, so $13,000 times the declining balance rate. Our declining balance rate is 40%, so times 40% or 0.4. So $13,000 times 0.4 is going to give us annual expense of $5,200. The very first year, our accumulated depreciation is equal to our annual expense because there's no prior depreciation. So $5,200 plus 0 from the prior year. And then our book value is the original cost less the accumulated depreciation. So it's going to be the $13,000 minus the $5,200, and we get $7,800. And again, this method is different from the other methods in that it doesn't consider residual value in the beginning. It considers it at the end, and we'll see where we get with that. So now, year 2. Year 2, the beginning book value is the ending book value from the prior year. So we take the ending book value from 2014 of $7,800 and put it in our beginning book value for this year. Then we're going to multiply it by the 40% declining balance rate. So we're going to multiply that $7,800 times 40%, again, just like we did before, but now our beginning book value is different. So $7,800 times 40% gives us $3,120. Now, our accumulated depreciation will be last year's accumulated depreciation of $5,200 plus this $3,120 of depreciation expense from this year. So we're going to get the $8,320. So what that is going to be, again, just like we did before, it's last year's accumulated depreciation plus the annual expense from this year. Okay, and that's what we're getting the $8,320 from. So last time's accumulated depreciation plus this month's annual expense, this year's annual expense. So then our book value is always going to be the original cost of $13,000 less our accumulated depreciation of $8,320. So we'll take $13,000 minus $8,320, and we will get $4,680. So for 2016, 2016, we're taking the ending book value from 2015. So we're taking the 4,680 times 40%, and we get 1,872. That's our annual depreciation for 2016. We'll add that to the accumulated depreciation from last time of 8,320. We get 10,192. And then our book value is always going to be the original cost of $13,000 minus the accumulated depreciation, in this case 10,192, and that gets us 2,808. We're going to do exactly the same thing for 2017 because I want to get to 2018. 2018 is different. So 2017, we're going to take our ending book value from last time, 2,808. We're going to multiply that by that 40%, by that double declining balance rate, and we'll get 1,123. We're going to add the 1,123 to the 10,192. And we'll get 11,315. We take that, subtract from 13,000, and we get 1,685. Okay, now 2018 is the last year of this asset's life, and this is where it's different. Up until this point, we have not considered the residual value. Residual value comes into the end. We can never depreciate an asset less than its residual value. So the book value of this asset can never drop below $1,000. So let's look at 2018. So 2018, we have a book value of $1,685. Now, if we were to take 40% of that, that would be more than $685 because that would take us to a residual book value of less than $1,000. So what we have to do in this year is we're simply going to adjust the annual expense to whatever above the residual value we need. So if we have, in this case, we have a book value of $1,685. I subtract the residual value of $1,000. That's how I got the $685. We can't take more than $685 because if we did, we would be below the residual value. We can never depreciate below residual value regardless of what method we're using. This sometimes can happen in an earlier year. It doesn't always happen in the last year of the life. It could be the second to last year. It just depends on the situation. So you can never, the rule to remember is you can never depreciate below the residual value. So this, we just had to solve for it by taking, we know it's the last year. We know the book value has to be $1,000 at the end. We have a beginning book value of $1,685, so we have to take the difference between that and the residual value. However, that works too. But for the last year, sometimes you have to do this in the second to last year. You just mentally have to note that that ending book value can never be less than the residual value. So that $1,000 at the end can't be any less. It has to be $1,000. So you can back into it. If you're in year 5, sometimes you need to worry about it in earlier years. Probably not in our circumstances in this class. Yeah, and Joshua, we might need to look at that in year 4 as well. So that's why there's not a hard, fast rule for that. Because you could, in theory, have no depreciation for year 5, depending on how your estimated life and your the numbers, your residual value. Basically, it comes down to that. Okay, there's a very specific reason that we do double declining balance method. Because you think of it, you say, well, straight line's so much easier, and units of production conceptually is easier. I think double declining balance is kind of odd because you take a lot of depreciation up front. The reason we cover double declining balance is when you do your taxes, first of all, when you do your taxes, taxes have a special depreciation method when you do taxes. That is dictated by the IRS. And the IRS uses a method called Modified Accelerated Cost Recovery Sustain. It's called MACRS. And MACRS, and this is not on an exam or anything, we're not teaching tax here, but from a tax standpoint, the federal government lets you do an accelerated depreciation method. Double declining balance method is considered to be an accelerated depreciation method. Accelerated means that you take a lot of expense in the early parts and less later on. And the reason that's good for you on your taxes is because I would rather have a lot of deduction this year than a couple years down the road. If I have a lot of deduction early on, that means I save taxes. If I save taxes, I have more cash and I can invest cash. The rule of thumb, we want cash earlier. We want to use our money as long as we can. We want more cash up front. If we have more cash up front, we can invest it and earn more money. So this MACRS, or this accelerated depreciation method used on taxes is, I wanted to do this double declining balance because it kind of mocks, it simulates. It's very similar to what is done when you do taxes, when you depreciate items on your taxes. Now, a company does not have to use the same depreciation method on its taxes. And again, this is the government making rules, but the IRS has said, the IRS tax code says you can use MACRS on your taxes, an accelerated depreciation method. And on your books for financial statements, you can use straight line. It's perfectly fine. There's nothing illegal about it. There's nothing unethical about it. You are allowed to choose. So what a lot of companies will do is use straight line for books because it is easier and it spreads the cost evenly, and then they use the accelerated method for their taxes. And accelerated method, you're going to get a bigger tax deduction up front, gives you cash earlier, because you want cash earlier. You want to use your money as long as possible. So there's that discourse. So absolutely fine. You can use either method for you can use different methods for your financial statements or your books than for your taxes. Totally legal and ethical. You're not doing anything wrong when you use two different methods. Because remember, your tax return is not your financial statement. Your tax return is based on IRS code and what the law is, and that law is based on what the government wants to collect in their revenue policies. Your financial statements, the framework on those are built on conveying information, useful information. Okay, so comparing the depreciation methods. So straight line method, it has a lot of appeal. If you say you bought this piece of equipment, you're going to use it for 5 years, straight line method is going to spread that depreciation expense over the 5 years. So intuitively, that makes sense. Okay, units of production method. Units of production method, companies like to use that when they have assets that wear out due to usage that they can measure. Because it does, if you use a lot one year and you're using a lot and it wears more that year, then take more depreciation. So that makes some intuitive sense. And again, these are not hard, fast rules. Companies are free to choose what method they want. The double declining balance method, if you're talking about for your financial statements, it's best for assets that generate more revenue early in the life. And so you could have a product that's going to be an absolute cash generator for the first 2 years and then not so much in later years. So a double declining balance method would make sense. You're going to take more depreciation early on, less later on. And again, depreciation is not a valuation method. It's not meant to say, here's what the asset's worth. We're trying to match the expense of the asset with the revenues it helps generate. Okay, just another, a little bit to emphasize on the double decline balance method. It is different from the other two methods, from straight line and units of production. The first year depreciation is based on the full cost of the asset. We're not subtracting the residual value. The other two, we always have to take the original cost, subtract the residual value. And the final year depreciation, or the somewhere in the end, towards the end of the life, it's a plug amount. It's basically what amount do we need to make that book value equal to its residual value or salvage value. Note that all three methods, when we look at all three methods, they will produce exactly the same amount of depreciation for the life of the asset. So when we looked at the delivery van example, we had $12,000 of depreciation for straight line. We had a total of $12,000 for units of production, and we had a total of $12,000 for double declining balance. It's just the timing, and we're interested in the timing. We select one based on our philosophy and what we think suits our business best, but they all will produce the same total. Okay, and back to this tax purposes. So again, we can use a different method for tax purposes. Typically, companies will pick accelerated depreciation method. Accelerated depreciation provides the fastest tax deductions. We get the big tax deduction early in the life of the asset. That bigger tax deduction decreases our tax payments. So we have less cash going out for tax payments, and then that leaves, we can take those tax savings and reinvest them and earn money over the remaining life of the asset. Okay, partial years. So we've got a few odds and ends to sew up here. First of all, partial years. We did our example where we purchased it January 2nd, so we had a whole year. Companies buy things in the middle of the year. So we have to compute depreciation for partial year. So let's suppose that UPS purchases a warehouse building on April 1st for $500,000. Estimated useful life is 20 years, and estimated residual value is $80,000. So let's compute the depreciation for the first year, assuming UPS has a December 1st year end. So the straight line depreciation, let's take the $500,000 cost less than residual value of $80,000 divided by the estimated useful life, that's 20 years, gives us $21,000 a year of depreciation. That's for a full year. It told us that UPS bought this building, this warehouse, on April 1st. If they purchase it on April 1st, that means they have 9 months of depreciation. And again, be very careful with number of months. And this is the biggest thing I see people get tripped up on here. They'll count the months wrong. Like they'll use 4 as the number of months and then get 8, and that's wrong. So you really have to be careful. If we purchased it April 1st, we think about how much depreciation we have for the year. We're going to have depreciation for April through December, which is 9 months. So what we're going to see is we're going to do the $21,000 full year depreciation times 9/12. So you always take the number of months divided by the years. We have 9 months of depreciation that we own this. We own this 9 months in the year. So we take the full year depreciation, $21,000 times the 9 divided by 12 to give us $15,750 of depreciation for the first year. So we could have partial depreciation in year 1. We can have partial depreciation in the last year as well, because it's always, it goes its number of years. So just keep in mind, if you have partial years, you need to make adjustments for that. Okay, two other small topics, and I don't want to dwell on them, but I did want to mention them, and we did get a question. Okay, so early on we had a question in the discussion board about what happens when it turns out that our estimates are wrong. So at the beginning, when we buy, say, a delivery van, we have to estimate two things. We have to estimate how long we're going to have it in service, and we have to estimate its residual value. If something significantly changes partway through and we realize that that estimated life is completely wrong or the estimated residual value is completely wrong, we have to change our estimate and then we change our depreciation going forward. We typically don't go back and adjust. That said, you do not need to know that. Just know that when we make a change, if we change the useful life of depreciable asset, there's an adjustment required. You don't need to know anything beyond that. I just want to mention that we do have to deal with changes in estimates, but it's usually not very often. Okay, and then we have a situation where we've reached the end of the estimated life of an asset, and it's fully depreciated, meaning that its residual value, its book value is equal to the residual value. It could be zero. They could have a book value of zero if we had no residual value. We can totally keep using it. We can keep using it until we don't want it anymore. We can simply use it. We don't take any depreciation if it's fully depreciated. So that's not a problem. So just because it's fully depreciated doesn't mean we get rid of it. We can continue using a fully depreciated asset. When we sell an asset or throw it away, we have to remove it from our books. So when we remove it, we have to take it out of the plan asset account. We have to take out its accumulated depreciation. And we, again, are not going to get into disposals. So this is called plant asset disposal. It's a huge topic. It's especially huge on tax returns. What happens when you get rid of a plant asset? You sell it, you trash it, you recycle it, do something. You have to remove it from your books. A lot of times there's a gain or loss involved, but that's beyond the scope of our class. If you're an accounting major, you will definitely see that in later classes. Okay, and then I just wanted to go back to Disney briefly. We talked about Disney on Monday, and again, just to refresh, Disney has their parks, resorts, and other property as their plant assets on their balance sheet. This is off their 10K for 2014. They list attractions, buildings, and equipment. Then they list accumulated depreciation. Now you know what that is. That's a running total of all their depreciation to date. So we see that they had $42,263,000, and then they had accumulated depreciation. It's shown with minus signs around it because it is a contra asset. It reduces the asset. So their net book value of their attractions, building, and equipment is $18,541,000. And then they go on to tell you they have projects in progress. Projects in progress, meaning these are things they're building. They're building new exhibits all the time, new attractions. As they build them, they are not depreciated. They don't get depreciated until they're placed into service. So they're telling you they've got things in the works they're working on, not depreciating yet. And then land. Land does not have an accumulated depreciation account because it is never depreciated. So that's what you're seeing in their financial statements. That's what we just talked about. One other thing that's kind of interesting in their financial statements is that tells you the life that they use for their various assets. The first one, attractions. So these are when they build Magic Mountain or they build It's a Small World, they're using a life of 25 to 40 years. Now they're making predictions, but that's their range. So they're disclosing to users of the financial statements that they're using this range of 25 to 40 years. Buildings and improvements, they use 20 to 40 years. Leasehold improvements. Now, leasehold improvements, remember, these would be places that they don't own. They're leasing, but they've made improvements to them. It would be the life of the lease or the asset life if left. So they're saying if they have a 20-year lease, they're going to depreciate their leasehold improvements over the 20-year lease. Okay. Okay, and I'm going to address that question too. That's actually a good question. Somebody just wrote, if they have land reappraised and it reaches a higher value, are the books updated? No, no, no. There is an accounting principle called historical cost. All our items on our books are recorded at original cost. We do not mark them up. The exception, there are a few small exceptions. One of them is marketable securities that are trading on the New York Stock Exchange, and we can point to them and go, oh, here's the quote. We cannot go through and adjust historical costs. Everything on our books is historical cost with a few narrow exceptions. Okay, so land improvements, 20 to 40 years, and then furniture, fixtures, and equipment, 3 to 25 years. So they have a certain amount of discretion they use, and there is reasoning behind the lives that they're picking. Okay, so we're going to do a homework exercise, short exercise 7-4. Okay. 7-4. We're told to calculate depreciation. We purchased a used aircraft at a cost of $52,400,000. They expect the plane to remain useful for 5 years, 7.3 million miles, and have a residual value of 6.4 million, and it gives us the miles. So we're told to compute the depreciation for the first 2 years on the plane using the following methods. So straight line. So straight line, first year depreciation. I'm going to do all three methods using first year depreciation. Then I'll do all three methods for second year. So straight line. Straight line, we're going to take the cost of the plane, the $52,400,000, subtract the residual value of $6,400,000, divide by 5 years, and I get straight line depreciation of $9,200,000. We are not told anything for partial years, so we don't have to worry about it. So we're just going to do that. So that is straight line to first year. It's going to be the original cost less the residual value, divide by the estimated life. That's straight line. That's actually the same amount for year 2, year 3, year 4, year 5. So that's why straight line is so easy. You get the same amount, and it's what you do each year. Okay, next up, we're going to do first year, depreciable value, depreciable cost, okay? Okay, units of production. So straight line's still there. Units of production, we take the depreciable cost, that $52,400,000, subtract the residual value of $6,400,000, divide by the total life in miles, and the life in miles were given up here in the problem as 7,300,000 miles. Okay, so that's where we're getting this number here. And we get $6.30 a mile depreciation. So depreciable cost divided by the life in miles, we get $6.30 a mile. So what we're going to do is we're going to do $6.30 a mile times the 835,000 miles they flew the first year. Where did I get the 835,000 miles the first year? That would be given to me in the problem up here. So I'm going to multiply that. So I get depreciation under units of production for the first year of 5,260,500. And then we go on to double declining balance method. Double declining balance method, we have to get our factor. Our factor will always be 2. Why 2? Because it's double. That's why it will always be 2. 2 divided by the life in years, it tells us 5 years, so it's 40%. So when I get my double declining balance, I'm going to take the $52,400,000 cost times the 40%, and I get $20,960,000. Okay, so that's year one. It told us to do the first 2 years. So now we have to go back and do the second year. Second year depreciation. Straight line, going to be exactly the same, right? Depreciable cost divided by the life, going to be the same every year. So that's easy. Units of production, that $6.30 figure that we got from taking the depreciable cost divided by the life and the miles, that's the same. So 630 times the number of miles they flew in the second year, 1,650,000 gives us depreciation of 10,395,000. And it'll stay up there. So double declining balance method. Now double declining balance method, you have to take your book value each year. Our book value in year 2 is the original cost of $52,400,000 less the depreciation from year 1 under double declining balance. And our depreciation from year 1 was $20,960,000. So you're always taking the current book value times 40%. So we get $12,576,000. So that's requirement 1. Requirement 1 was to calculate the depreciation for the first year and the second year using each of the 3 methods. And the final step feels like a lot of writing, but it's not bad. It's show the airplane's book value at each of the at the end of the first year under each depreciation method. So that's not bad. We're looking for the book value at the end of the first year under each depreciation method. So what we're going to see, book value is always the original cost less the accumulated depreciation. For the first year, our accumulated depreciation is equal to our depreciation expense. Okay, so what I've done right here is the original cost less accumulated depreciation equals book value. All I'm going to do is I'm going to do 3 columns. I'm going to do 1 column for straight line, 1 for units of production. So it just changes form here. So the original cost less accumulated depreciation is going to give us our book value. So what I've done, the original cost for every method is going to be that $52,400,000. That doesn't change. The accumulated depreciation, this is for the first year, is going to be the amount of the depreciation expense for that first year because we don't have any prior balance to add it to. And then the book value then is the cost less the accumulated depreciation. So that's all you have to do for that. We see straight line book value $43,200,000. Units of production 47,139,500, and then double declining balance method is 31,440,000. Okay, we're going to do a couple questions now. So we're going to see a couple questions coming out. This first question that's coming out, I don't mean it as a trick question. And I'll tell you, before I put it up, the only account, remember, the only account that is not depreciated is land. Land has an infinite life, right? So land is never depreciated. But things that are on land, like a parking lot is depreciated. Lighting or fencing that we put up that are put on land, those are improvements to land and those are depreciated. So our first question is out there. Land improvements are subject to depreciation. True or false? Okay. Answer the one that, who knows what we're answering here. And this is probably, let's do, wait, don't, I'm not, hold on, that went crazy here. Okay. Okay, we're going to do this one twice. So we're going to close it now. So make sure you have an answer. I'm going to close it now. We're going to see which one I have entered on there. Okay. Yeah, in that, yeah. Okay. You've got to answer to get credit. So if you don't answer this time, you're not going to get it on the second try either. 5 seconds and we're going to close this. It doesn't matter what you answer this time. If you're watching the recording, this is absolutely true. Land improvements are subject to depreciation. And let's close it. Okay. And this one's false, so it's answered correctly. Okay, so let's redeliver this one. Okay, and it's using the right answer. It's using false. So the one that you have is false. This one's true, right? Because that makes sense. Yours is exactly opposite of what I have up here. So your answer, ignoring what's up here, your answer, the second attempt, has to be false. Okay? False. No, you shouldn't be. No, you shouldn't, Joshua, you shouldn't be, the second question should be coming up now. You shouldn't be confused. It's just in my PowerPoint, I had it written the opposite way. So mine was true because there was not a not in the question. In Learning Catalytics, there is a not in the question, so it's false. And I did because of the confusion, we just closed it. We're redelivering it. If you're not seeing the question, you should hit refresh. Right now, 3% of you have this question wrong. Remember that the question that you're looking at in Learning Catalytics is false, okay? We're going to close it in 5 seconds. The answer is false. You don't have to worry about that I do not understand button. It doesn't do anything. No, you didn't change the answer to get it wrong. It's just you're answering false because the question in Learning Catalytics doesn't match this one exactly. It's opposite. Okay. We're not going to keep it open anymore. Okay, close it. Okay. Okay, book value equals the cost of the asset less the accumulated depreciation. True or false? Book value equals the cost of the asset, the original cost of the asset, less the total accumulated depreciation. Okay, book value equals the cost of the asset, the original cost of the asset, less the total accumulated depreciation. This should be in your notes. We're going to close it in about 10 seconds. $9:02? Okay. Boy, time flies. Sorry, John. Okay. So we are going to close this, and we will be done. Sorry, I just got caught up. So much for that get out early thing, huh? Never believe me when I tell you that. Okay, the answer would be true, and we're going to close it. And then have a nice weekend, and I'll see you next week. Sorry about the 2 minutes. I'll make it up next week.